Hello, I'm Jim Jubak, and welcome to my YouTube channel for today, Wednesday, January 27th. If you like this and want to see more of my stuff, you can go to my free site, which is jubakpicks.com, or to my subscription site, which has even more things, even more portfolios, and that's at jubakam.com. If you subscribe to this channel, my YouTube channel, you'll get notification when a new video goes up. If you like this video, please like it. That would be great. Today's topic is, and let me just get the title straight, forget GameStop, it's the Fed's bubble to burst. Okay, let's look at a couple of charts. And we'll start with GameStop because it's in the headlines today, or has been for the past couple of weeks. You'll notice this is just a calm chart that just chugs along and then goes completely parabolic. Not even parabolic, just goes completely to the sky. So GameStop is up as of noon today, another 111%. That's just the day. So this is a stock that's now trading at 312 at this moment. It was at 1725 on January 4th, so roughly 2 weeks ago. Quite a bit of activity going on, a classic short squeeze. Retail investors are just hammering away at all the shorts and hedge funds and making a lot of money in the process. And now they're going out and looking at other stocks that fit this pattern. So there's AMC, which, you know, hey, this is a movie theater chain. No one's going to movies in most of the country, so possibility of this chain going bankrupt. But here we see the same thing happening. This is very, very shorted stock. Lots of people have borrowed shares, sold them, and are now we're anticipating that they could buy them back at a lower price. But of course, if you're short and this starts to happen to you, you rush to cover, which means you buy instead of selling. So you drive this all the way up. And so we're talking about AMC being up, what are we up? Another 182%. And this was a stock that's now trading at about 14 bucks. And on January 5th, it was $1.98. Okay, these are the headline stocks. There's a lot of action going on here. One of the things that goes on at this point in a market rally, when we get to the point where we're looking at what looks like a bubble, is we start to get these extreme reactions. It's very, very dangerous here to go short or to bet against the market because you get pummeled. The attraction of going short, of course, is that at some point this will all break, but today's action in the market gives us a sense of what it is that's going to break. And let's look at the S&P chart. Let me find it. Here we go. Because this tells us something really important today. What we're looking at is what's going on right here. As of noon, the S&P 500 index was down about 2%. The Dow down about 1.5%. The NASDAQ down about 1.85%. So we're not seeing any positive action anywhere in the market. We're seeing a big sell-off, and you're going to ask why? Well, yesterday we got great bust-out earnings from Microsoft, but today Apple, which is due to report, is doing nothing. We're looking at basically a flat stock. Even though everyone's anticipating that Apple is going to announce record December quarter earnings today, we're not seeing any action. And why is this? Because today is also the Fed's meeting. So the Fed meets today, later this afternoon, about 2 p.m. And today's action is a reminder that, well, this is the Fed's bubble. The bubble will burst when the Fed stops putting all this money into it, and Wall Street is trying to figure out when that's going to be. The likelihood is that we're going to see right now from the Fed today is some very, very dovish comments. Dovish in the sense that the Fed will say, well, we're not at all worried about the economy overheating. We see no reason to raise interest rates anytime soon. We also don't think the economy is strong enough so we can stop bond buying. That's the market's schedule, and I think this is correct, is that before we get around to the Fed raising interest rates, we will get the Fed cutting back on its monthly bond purchases. It's buying about $180 billion worth of bonds. No, $120 billion worth of bonds right now. That's about $80 billion in treasuries and about $40 billion in mortgage-backed securities. That's every month. This is new money going into the market available to drive a rally like this. Last time, when the Fed decided that it was going to start cutting back, it made an announcement that it was going to do that. It hadn't even decided that it was going to yet, just saying we're thinking about it. And we had in 2013, we had become the classic taper tantrum, as it's called, when the market basically said, hey, Fed, no, you're not going to do this because we're going to just dump everything. And then the Fed then had to deal with the fact that the market was in revolt. What we're looking at here is Wall Street saying, yes, indeed, at some point the economy will get to be strong enough so the Fed will not want to be buying $120 billion worth of bonds every month. At some point they will announce that. We would love to be out of this market ahead of that announcement because you're looking at sort of like dominoes, flump, thump, thump. The announcement that they're thinking about this, the actual announcement that we're going to do this, and then leading into the Fed's decision to raise interest rates, which is what the market is ultimately most worried about. Again, it doesn't look like we're going to get higher interest rates until 2023, maybe. But if you take the Wall Street models for the market, and basically Wall Street is saying stocks in this market are reasonably priced as long as interest rates stay this low. So that's the real crux here. This rally goes on until the Fed says, hey, we're taking steps that will eventually lead somewhere down the road to higher interest rates. And at that point, the market says, whoa, we don't want to stay here at these valuations. Today, I don't think we're going to get anything that really rocks the boat. In fact, I think we're going to get the Fed being reassuring. The next meeting, with a good chance of something substantial happening, not every meeting of the Fed's Open Market Committee results in some actions. Next one I'd say is March 17th, because that's a meeting where we're going to get more economic projections. Any move by the Fed will be based on their read of the economy. So March 17th, again, I think that's too early. The economy is still going to be really rough. After that, we're looking at something in June, maybe September. I'd worry about that as my scenario for seeing more pressure on this market, much like we have today. So thank you for watching. This has been Jim Jubak on YouTube. If you want to see more of my stuff, you can go to my free site, which is jubakpicks.com. That's got 3 portfolios for dividends, 18-month and 5 years or longer. Or you can go to my subscription site, jubakam.com, which has got more portfolios, including a newly launched portfolio called the Millennium Portfolio for investors who have a long time frame, but not necessarily very much money right now. So those are my sites. If you want to subscribe to this video, please do so. That'll mean you get notices that there were new ones going up. And if you like today's video, please like it. Thanks very much.